performance measurement. An operational performance measurement are actually the key metrics which are used to measure the operational performance of a company. But every company doesn't have the same measurement. So different companies have different metrics to measure their own employees or their own performance. But few of those metrics are very common. You can see every company those kind of performance measurement. One of them probably customer satisfaction index. Another might be employee satisfaction index, revenue generation, productivity, gross profit. And not every measurement is actually financial. So, and we will see and discuss about those performance. So let me walk you through what we are expected in this class. I will look the learning objectives one by one. And before we do anything else, I like to bring you back to the book, chapter 14. It features a story about United Parcel Services, UPS. And when you read read that story, you can see how that company was started 1907, and immediately after that, I mean, not right away, but it started, UPS became a successful. As you know, every one of us know how UPS is very successful at this point. And one of those successes is that they had standardized activities. And we will talk about those things. Their operational performance measurement is the key for the success of that company. So before we do anything else, we'll talk about what is control. We talk about control. Control. So what is control actually? It's just a control. When we're talking about the company talks about control, it is set of procedures. Okay, set of procedures, tools, and systems organization. Okay, and what is the objective of all these procedures? The objective is to actually accomplish the organization's goals, the goals of the company. Because if the place becomes a meat house that everybody does whatever they wanted and how they want it, and there is no actually procedures to follow, it will be a problem. It will be a disaster for the company. Okay. We call accounting in these controls, we call in accounting management, accounting, and control systems. That's what we call management, accounting, and control systems. Okay, that's what we call in accounting. So in the core performance of measurement for management, accounting, and control is both planning and evaluation. And evaluation, what do we mean is just the feedback. Okay, is a feedback. So what the company needs, and every company needs, is a comprehensive management, accounting, and control systems. If the company has that, normally the management and comprehensive control systems. Let me go to the other side. Okay, let's look. If you have a comprehensive management, accounting, and control systems. Let me just summarize that. If you have that, it has subdivisions. So you will have management control system. You will have management control system, and you will have operational control systems. Because every business not only needs the accounting numbers and all that, but also needs the data. And that's why it's important. When we look, the operational control normally focuses the side of financial, of course, normally focuses short term. And later we will talk about limitation of this. So focuses on short-term operational performance, operational performance. Okay. And what are these? Such as business process activities. There are, to be performed business processes so they can deliver the output. When we're talking about business process to deliver output to customers. So business process, actually, the company has to have business processes, several business processes, and those are mostly are non-financial measurements. Okay, so let me go to the next page. Operational performance has two performance dimensions. Operational performance. Number one is financial, and the other one is non-financial. Okay, and the other one was non-financial. So in order to have effective operational control systems, we also have to look the performance indicators of both. We have to have performance, or just call it indicators, performance indicators. So financial, you have performance indicators, and non-financial, you will have performance indicators. Okay. The other thing is we need to also understand what is financial control means. Financial control is actually comparing actual and budgeted financial amounts. You compare actual to budgeted actual to budgeted financial amounts. Okay. So you have both budgeted, you compare both of them. That is financial control. So the difference between the actual and the difference between budgeted amounts and the actual financial results are called, it has a name, it's called in the book variances. It's not the variance we talk about in statistics. So you look in the actual and the budgeted financial, the difference, whether that difference is increase or decrease, we are not talking about. Those are called variance. Okay. And when you look, uh, okay, let's see. When you look at budgeted, when you compare the actual to the budgeted, you will see in the statement or the financial statement, in that case, you will see favorable or unfavorable. So favorable variance, let's call favorable variance, and unfavorable variance. So the favorable variance means that the increase is a short-term operating, it's called short-term operating income. Short-term operating income. And this is the opposite. Okay, it's the opposite. So it's unfavorable. Okay. Before I go to that next one, let me have a space and probably erase all this. Okay. So how we develop an operational control system? Developing operational control systems. How we develop. So number one, what we do is you have to determine the strategic issues. What is that? Strategic issues surrounding the problem that you are facing. Okay. Selling a high price product, to those who value that it is quality and design and functionality and all that is great. But you have to always keep in mind there are competition. There are competitions, foreign and domestic. Okay. Normally foreign companies compete all the time, as you know, cheaper labor and all kinds of other things and raw materials, getting into the price. But if you stick to the high priced product, eventually you will not be in business. So the other problem is the price competition. So what happens? You have to, in that case, you have to find ways to maintain profitability. You have to find ways to maintain profitability. Okay? You have to find ways. And also quality and quality. Because the quality itself is not that you have to please yourself as the owner of the company or the employees. The main thing, you have to please the customers. What do they describe? What quality they love? What quality they offer money? Reasonable, not too high, not too expensive. How you accomplish those? The way you can accomplish is by improving operational efficiency. Operational efficiency. Efficiency. Okay. So you can maintain profitability, quality, but make sure that the operation is so efficient and not wasted. I mean, the control we will be talking about all along. Very important. That is number one. So you have to develop operational control system. So number one is the what we call determine the strategic issue. So you have to have a conversation with yourself, with the company, the product that you are having, how you're going to compete, and it's still make money. Not just the brand that you are producing is very high quality and highly priced and all those things. So improve the operational efficiency. That is that. Let me erase this. Okay. Okay, the second one is identify alternative actions. Identify alternative actions. Actions. Okay. So, such as target costing in the context of product redesign. Target costing. So, product redesign is very important. Redesign. The only reason you're trying to do is uh, you have to reduce the cost. If you redesign the product, get different raw materials, probably a little bit cheaper, but not sacrificing the quality, so you can reduce the cost. So that is one of the uh, finding an alternative. At the same time, maintain quality. Maintain quality. Okay. So that is the identifying alternatives. Okay, the third one is obtain information and conduct analysis of these alternatives. For example, you're trying to redesign, but you cannot just jump into this, into this idea right away. So you have to gather information. So let me also this one erase. Okay, number 3 is obtain information. Okay. And after you get the information, you have to conduct analysis. Analyze that information. Okay. Analyze, conduct analysis of that information or the alternatives. If operational control systems fully implemented, you will capture both financial, you will capture both financial and non-financial. Okay, very important. And non-financial performance data. Performance data. Because we are living in the information age, it's very important that we have, because financial information include budgeted results. Financial information has budget results like sales volume, sales mix, selling price, okay, variable cost per unit, total fixed cost. That information is under the financial, okay? So if you want to experiment and try to develop new system, you have to always think about consult with your engineers, and engineers will study that product redesign for the main reasons of saving or reduction of cost. So that is information. Get first information. Without information, you cannot do anything else. Okay. Okay, number 4. Let me erase this. Number 4 is based on the strategy and analysis. It connects to the first one, that is the third one. So based on the strategy and analysis, choose and implement the desired, or let me just summarize, choose the desired alternative. So you have to choose, after you did the analysis and all that, then choose the best one and implement that desired one. Product redesign, the reality is product redesign is risky. Okay. So it may, if you do that, it may jeopardize quality, image of the company. So the best way in that case, without risking all that, you have to implement operational control system. Okay, control system. Very important. And we already talked about operational control system is the best way because it includes financial and non-financial information. Okay. And then after that, number 5, let me erase this. Number 5, after that, provide an ongoing evaluations. Provide ongoing evaluations of the effectiveness and implementation in step number 4. That was the choosing the alternative. So you have to always be evaluating. Management always should evaluate its approach to delivering companies differentiated product profitability. They just have to continuously evaluate. Very important. Okay. So we talk about developing an operational control system. And I want you guys to remember this. Number one, we said determine the strategic issues. Number two, we said identify alternative actions. Number three, obtain information and conduct analysis. Number four, based on the strategy and analysis, choose and implement the desired alternative. And five, provide an ongoing evaluation of the effectiveness and implementation in step four. So those are very important. And these can be applied any company. Maybe each company may have different data, different financial, different budget, different culture in the environment. But these are general. All you have to do is tweak based on the company. Okay. So now define and interpret master budget variance of a given period. Okay. So we just have to understand what we call budget. And master budget variance, so this master budget variance is actually the difference between, it is just a difference between actual operating income and the master budget operating income for the period. So that is the master budget variance, the difference. Remember variance, we said the actual, the difference between the actual and budgeted variances. So that is, so let's go into, let's see, what is actually budget? Let me see here. Go back. So what is budget? When we say budget, it's just a detailed plan for the acquisition and use of financial and other resources over a specified period, okay? Over specified period. That is what budget is. So when we say specified period, it might be quarterly, it might be monthly, it might be annually or yearly. That is what budget is all about, using it. So budget itself includes both financial and non-financial aspects of planned operations and projects. So the master budget is, when we call master, it collects all the uh, uh, subunit of budgets into integrated plan of actions. It's aggregation. That's what we call aggregation, the master budget. And it comprises both operating budget and financial budget. Operating budget and financial budget. So operating budget, which is plans for all phases of operating of operation. So all the plans, that's called operating budget, plans for all phases of operation, including production phase, purchasing, personnel, marketing, and so on. So that is the operating budget. The financial budget, financial budget identify and relate to sources and uses of the funds. Sources and uses of the funds. So it mentions the source of that money, the fund, and what will be used for. And also capital expenditures and capital expenditure. Okay, and capital expenditure. Okay, master budget actually is useful for initial planning and coordination of activities for a given period. Okay, it is whenever the budget is set, that is the time it's going to be coordinated, and we will talk about later how the process of budget will work. So operating conditions, however, turn out exactly. I mean, seldom they don't turn out. If you have a budget for something, and normally budget we're talking about future spending, future production, future those kind of things. Let's say you budgeted $500,000. Well, possibility you might spend a million. You might spend less probably. Mostly it's always or closer to 650,000 or something like that. So it's not going to be exactly the same. You're not going to match because nobody knows what will happen in the future. If you guys are following today, the tariffs that was imposed between Canada and United States, or if you look at, you can see how things can just go south right away. I mean, you just have to look how things are. Anything can change. Raw materials can change. The policy of a government can change. So nothing is going to stay static and it stays the same. So that is the difference between the two will be called variance. Okay, so organization always have to revise the master budget. Okay, they always revise master budget, revise. Since it's not gonna turn out the way you want it. And before assessing any short-term financial performance. So the revised budget is called flexible budget. This is called revised budget. It's called the flexible budget. And that adjusts revenues and expenses to the actual output level and sales mix achieved. You right away accept. But the flexible budgets are useful for assessing short term. So it assesses short term financial performance. Okay. So management would like to raise, when that happens, management would like to raise the following questions and look for an answer. Questions like, why was the operating income less than expected? That is a one question. For example, you ask yourself why it is less than expected. And they might ask why costs went up. Costs went up. Okay. And how they prevent that. How to prevent. Because in this course, cost accounting, you are a manager. You're making decisions. You're asking the right questions. Why were short-term fixed costs are more than the expected? Why the disappointing financial results attributed to changes? Is it because the financial, let me rephrase what I said. Were the disappointing financial results attributable to changes? Is it because of the changes in unity sold, sales mix? Is it because sales price? Is it because of selling administrative cost? Those kind of things you have to ask. And I think you guys have studied, when you are trying to calculate total cost, are you using traditional cost system or using uh, activity-based costing? When you compare the two, most of the time traditional uses uh, the rate, determined overhead uh, rate based on the direct labor hours. Just a single rate, that is what it is. But the activity-based costing actually uses several predetermined rate. And for that reason, if you compare both, the best is the activity-based costing. But at the same time, you'll be surprised and said, well, if that is the case, if it captures all the costs and actually it gives the company profitability, good pricing and all that, why everybody is not using A, B, C, or activity-based costing? And this is one of the things. It's not just because the method is great, gives you better, doesn't mean it is good for you as well. Because activity-based costing demands more detailed information. So for that reason, some of the firms or companies will say it's not worth it. So always have to evaluate, redesign. Somebody can say, oh, we have to reduce the cost, redesign the product to find the raw material cheaper. Guess what? You have to think about. That's why analysis is very important. You have to go back and say, ask yourself, okay, if we redesign, what happens to quality? What happens to the image of our company? Those kind of things are important. Okay, and those we already talked about. Standard costing, cost. So what is standard cost? Is the cost the organization should incur for the operation under relatively efficient conditions. So standard cost is the organizational cost, organization cost under efficient conditions. under efficient, EIE, efficient conditions. Okay. Well, when we say standard, remember we talked about UPS earlier. We mentioned at the beginning UPS. UPS actually had a standard costing. Very important, very efficient control. Very important. It may not be the best, but if you have, if you are looking standard costing and all that and financial control, then you have to attach non-financial control as well. You just have to look those. Okay. Standard costing are incorporated into the budget and as such can be used to monitor, and control operations. Control operations. Okay. And evaluate performance. Evaluate performance. As you know, change is not easy. It's not easy for companies. It's not easy for individual. But the change is reality, life. Uh, as you guys already know, most of you are practically working managers, very successful individuals. How when COVID came, remember what changes was happened in businesses, education systems, and that's why today we're talking about different modality of education. Had that not happened, we would not have change. So that kind of a change was forced to us, but it was a good change. So the standard cost is created to monitor and control operations and evaluate performance. But the standard costs don't mix with the standard cost with the standard cost systems. Both are different. Standard cost prescribes expected performance. It talks about expected performance. But the standard cost system is a cost accounting method that uses predetermined costs to plan, analyze, and control production. So the two shouldn't be mixed. Okay. Okay, let me erase. We're still talking about standard costing. Okay. So how many types of standard costs are there? So types of standard cost. One is called ideal standard. Standard costing. The ideal actually is the standard cost that reflects perfect implementation. Perfect implementation. Perfect implementation. Okay, and maximum efficiency in every aspect of the operation. That is very difficult. That is very difficult. So ideal standard is very difficult. Another standard is called continuous improvement standard. Continuous improvement standard. Standard that gets progressively tighter over time. I mean, it's more realistic than the ideal. And also another standard is called currently attainable standard. Currently attainable standard. Okay, so we have ideal standard, we have continuous improvement standard, we have currently attainable standard. What is currently attainable standard? Is a level of performance that workers with proper training and experience can attain most of the time without having to exert extraordinary effort. Well, definitely we know that employees, if they are highly trained, they easily, naturally do the job. So that is one of the standards. So that means you have to you have to invest your employees and make sure that they practically learn, what they are doing, and also be able to update themselves. Continuous education is the best interest for both the personnel and for the company. So how you set these standards? How you set, for example, ideal standard, continuous, uh, the currently attained, how you set those things? Well, one way is called authoritative standard, which means management can decide. It's like a dictator tells you what to do. I have this standard, do it. Don't worry about it. No questions asked. That's called authoritative standard. And the other one is called participated standard. Employees participate to develop the development of the standards. And I think whenever the employees participate, decisions made, after that, you can see they are very comfortable implementing those standards. But if you are imposed, it creates a headache for both. Okay. Recording manufacturing cost flows and associated variance in a standard cost systems. Here we're talking about how you trace the costs, how the cost flows from purchases of raw materials, RM, and then once you put together, and definitely you have to, what we're talking about, accounting system, in this case, whenever you receive the raw materials, you actually debit the raw materials, you credit either the cash you paid or the accounts payable, the future you are paying that. So you have a record, journal entries. And once you put these together, it becomes a work in process. So that will go to another account, another T account. It goes there. Okay. And after that, you will be calculating uh, what we call, you will be determining uh, cost of goods manufactured. After that, you determine cost of goods manufactured. Okay. And after that, it becomes a finished goods, and you sold those finished goods. You calculate cost of goods sold. So that is done in the accounting systems on that case. But we have to also remember and know this has what we call limitations of short-term financial control. It has a limitation, and it's not perfect, as we know that. It's not always numbers, do this, do that. It's not always the case. So if we look short term, oh, okay, short term. What happens to long term? You're sacrificing long term. So you always have to keep in mind not only trying managers to achieve decisions that they make, if it is for short term, then they are sacrificing long term improvement, long-term performance. That's what happens. For example, when purchasing non-standard raw materials may result purchase price variance for the purchasing manager. Okay. So, however, those will lower quality. So you achieve short term in this case because you purchase low quality and all that. But the question is the image of the company, and then those kind of things will be a problem. So for that reason, we just have to look non-financial performance. That's what we have to look. And that is where your book talks about business processes. You have to set what we call business processes. And those business processes, operating process, operating process, and customer management process, process. Okay. So these non-financial performance indicators are very important. And your book talks about in page 621, and you just have to read and understand that. And there are operating processes, many of them just-in-time manufacturing is very important, and it has its benefits, it has costs. So the book in page 623, just in time, or JIT 623. This is the page number that you have to look. I think that also, if you look page 625, we will be talking about advantages of non-financial measures of business process performance. So what is the benefits? That's what I am expected everybody to focus when they are preparing for this chapter. So there are so many things that this nice things that the book talks about. Calculations that normally the calculations we have seen in this chapter is not focused. Only the only thing they are talking about the difference between flexible budget and also master budget. And then when you get the results can be either favorable or not, or unfavorable, those kind of things. It's not a difficult math mention. That's all we say. I think everybody will have no problem preparing for this chapter. You have a wonderful day. Thank you, and we will stop right here.